There is a question that haunts every investor, every entrepreneur, every person trying to secure their financial future. It's a question that hums in the background of every market report, every tech conference, every breathless headline about the next big thing. The question is, what's going to change? We dedicate billions of dollars and countless hours of intellectual firepower trying to answer it. We build complex models to predict interest rates, consumer trends, and technological breakthroughs. We chase after whispers of disruption, hoping to catch the next rocket ship to the moon. We are a culture obsessed with the future, with predicting the next move on a chaotic, unpredictable chessboard. And for the vast majority of us, this obsession is a direct path to financial ruin. It is a gambler's game, rigged against us from the start. But what if the entire premise is wrong? What if the most powerful question isn't what's going to change, but its polar opposite? What if the secret to building lasting wealth, to achieving a state of profound financial freedom, lies in asking a much simpler, much quieter question: what's not going to change? This is the central operating principle of the most successful investor in human history, Warren Buffett. It is the genetic code of his entire philosophy, a mental model so powerful and yet so simple that it's almost offensive. While the rest of the world is staring at the horizon, searching for distant clouds, Buffett is looking down at the bedrock beneath his feet. He has built an empire not by predicting the rain, but by understanding the mountain. He focuses on what is durable, on what is predictable, on the fundamental human needs and desires that will be the same in 10, 20, even 50 years. This isn't just a folksy aphorism, it is a strategic weapon. It is the key that unlocks the ability to build a portfolio of businesses so stable, so dominant, so insulated from the whims of technological fads and market manias, that they become something more than investments. They become personal mints, printing money year after year, decade after decade, powered by the one force you can truly count on: human nature. By embracing this single, powerful shift in perspective, you move from being a speculator, a gambler tossed about on the waves of market sentiment, to being an owner, a proprietor of businesses built on the unshakable foundations of what it means to be human. You stop trying to predict the future, and instead, you decide to own a piece of it that is already guaranteed. This is the final promise of value investing, the ultimate secret to achieving lasting portfolio growth and beating the market not through frantic activity, but through profound stillness. Our journey today is a deep dive into this transformative idea. We will deconstruct it into its 5 core pillars, revealing not just the what but the why and the how. We will move from foundational stories drawn from Buffett's own legendary career to the deep psychological principles that make this strategy work on a primal human level. We will then translate that theory into a practical, step-by-step blueprint that you can apply to your own stock picking and wealth management. We will explore the disastrous path of those who ignore this wisdom, and finally, we will connect every single concept directly back to the cold hard numbers on a balance sheet and in your brokerage account. This is the masterclass in building a fortress of wealth that can withstand the test of time, an architecture for your financial life based on certainty in an age of hype. We begin with the foundational act, the mental judo flip that underpins this entire philosophy. We begin with the oracle's inversion, the deliberate choice to stop predicting what will be different, and instead, to master the art of predicting the unchanging. In the early months of 1972, Warren Buffett and his partner, Charlie Munger, were presented with an opportunity. It wasn't a revolutionary technology company, nor a high-flying conglomerate. It was a box of chocolates. Specifically, it was a family-owned candy company based in California called See's Candies. For Buffett, who had built his early career as a strict cigar butt investor, buying statistically cheap, often terrible businesses for one last puff of profit, See's was a radical departure. The company was being offered for $30 million. Its book value, the net value of its assets, was only about $8 million. This meant the sellers were asking for a $22 million premium for something that wasn't even on the balance sheet. The brand, the goodwill, the name. To the younger Buffett, this would have been an immediate deal breaker. Paying 3 times book value for a candy company seemed insane. But a decade of experience and the constant intellectual prodding of Charlie Munger had begun to change his mind. He was evolving from buying fair companies at wonderful prices to buying wonderful companies at fair prices. So he began to investigate. He and Munger didn't just look at the financials. They looked at the human reality of the business. See's Candies had been around since 1921. It was a California institution. Generations of families had bought their Valentine's Day chocolates, their Easter candies, their Christmas treats from the iconic black and white See's shops. The product wasn't just sugar and cocoa. It was nostalgia, tradition, and affordable luxury. When a young man went to his girlfriend's house to meet her parents for the first time, he didn't bring a generic box of chocolates from the supermarket. He brought a box of See's. It was a social signal. It said, "I have good taste, and I care enough to bring the best." This simple observation was the key. Buffett wasn't analyzing the candy industry's 5-year growth prospects. He wasn't building a complex model of cocoa futures. He was asking himself the invariant question, in 10 or 20 years, will people still be trying to impress their romantic interests? Will they still celebrate holidays with small, traditional gifts? Will the power of a trusted, nostalgic brand still command a premium price? The answer to all of these questions was a resounding yes. The internet could change everything. Transportation could be revolutionized, but the fundamental human wiring that See's tapped into was permanent. After some negotiation, Buffett and Munger, through their holding company Blue Chip Stamps, purchased See's Candies for $25 million. That $25 million investment has since generated, in aggregate, over $2 billion in pre-tax earnings for Berkshire Hathaway. It has done so without requiring significant additional capital investment. It became what Buffett would later call a dream business. It was the foundational experience that taught them the immense value of a durable competitive advantage tied to an unchanging human desire. See's didn't need to innovate constantly. It didn't need a massive research and development budget. It just needed to keep making high-quality candy and maintaining the pristine image of its brand. The business model from 1972 is almost identical to the business model today. The product is the same. The branding is the same. The human need it serves is the same. And the cash just keeps flowing. This single transaction was a turning point. It was the moment Buffett fully internalized the power of focusing not on the spreadsheets, but on the certainties of the human heart. And it laid the intellectual groundwork for his future Goliath investments in companies like Coca-Cola and American Express. It all started with a box of chocolates and a simple question about what would endure. The reason Buffett's inversion is so powerful and so rare is that it requires overriding some of the most deeply ingrained bugs in our mental software. Our brains are evolutionarily wired to notice change, not stasis. For our ancestors on the savannah, the rustle in the grass, the change, was the thing that mattered, not the unchanging rock next to it. This translates directly into modern investing through a cognitive trap known as the availability heuristic or salience bias. The news media, financial television, and social media are relentless fire hoses of information about what is new, what is disruptive, what is changing right now. Electric vehicles, artificial intelligence, gene editing, cryptocurrencies, these are the salient stories. They are readily available to our minds, and because they are so available, we dramatically overestimate their importance and our ability to profit from them. We see a handful of people get rich on a new trend, and our brain tells us, that could be me, this is the future. The quiet, boring, predictable success of a candy or soda company rarely makes headlines. It is not salient, it is not available, and so we ignore it. This is compounded by another powerful psychological force, the action bias. In the face of uncertainty, we have a deep-seated need to do something. Sitting still feels like passivity, like a failure of agency. When the market is buzzing about a new technology, the pressure to act, to buy, to get in on the ground floor is immense. We feel that if we don't participate, we are falling behind. Buffett's strategy is a conscious, deliberate rebellion against this impulse. It is the wisdom to understand that in investing, frenetic activity is almost always the enemy of good returns. True wealth management is not about making 100 brilliant decisions. It's about avoiding a handful of catastrophic ones. By inverting the question, Buffett creates a filter that automatically screens out the vast majority of noise. He's not interested in the rustling grass. He's interested in the granite bedrock. He is looking for businesses whose success is predicated on the absence of change. This requires immense discipline. It requires the emotional fortitude to watch others get temporarily rich on speculative fads while you stick to your principles. It's an act of intellectual humility, an admission that you cannot predict the future of complex, rapidly changing systems, but you can identify simple, durable patterns of human behavior. This psychological shift from active prediction to passive observation of invariance is the single greatest leap a retail investor can make on their journey to financial freedom. So how do you operationalize this? How do you turn this powerful philosophy into a repeatable process for your own stock picking and stock analysis? You can use a mental model I call the 10-year invariant test. It is a simple 4-step blueprint for applying Buffett's inversion to any potential investment. Step 1. Identify a company or an industry you are considering. Let's say it's a popular new software company that helps businesses manage their social media presence. Step 2. This is the critical inversion. Instead of immediately listing all the ways this company could grow or be disrupted, you must force yourself to do the opposite. Take out a piece of paper and write down 5 to 10 things about the underlying human or business need this company serves that you are virtually certain will be the same, or even more prominent, in 10, 20, or 50 years. For our social media software company, you might write, businesses will always need to communicate with their customers. Businesses will always seek a competitive edge in marketing. The desire for social status and connection will continue to drive human interaction. People will continue to spend a significant portion of their leisure time on networked platforms. These are the invariants. Step 3. Now analyze the company's current strategy and business model. Is its core value proposition built directly on these powerful invariants, or is it built on a fleeting, specific technological implementation? This is the crucial distinction. A company whose value is tied to the specific algorithm for a single social media platform is fragile. A company whose value is tied to the universal need for businesses to manage customer relationships across Tinebobata platform is far more durable. You must determine if the company is selling the timeless what or the temporary how. Step 4 is the invariant stress test. Imagine a series of radical technological or social shifts. Let's say a new, decentralized form of social media completely replaces Facebook and Twitter. Let's imagine holographic communication becomes the norm. Does the core human or business need that your company serves still exist? And is the company structured in a way that it could adapt to serve that need through the new technology? For See's Candies, even if we develop teleportation, people will still want to give a gift that signals affection and tradition. For Coca-Cola, even if we colonize Mars, people will still want a simple, refreshing, familiar taste that reminds them of home. If a business's reason for being survives these radical thought experiments, you have likely found an investment built on bedrock, not sand. This test forces you to separate the temporary from the timeless, and it is the most effective filter for avoiding the hype-driven mistakes that plague the average investor. The tragic beauty of Buffett's principle is best understood by examining its opposite. The path of the 99% is littered with the corpses of companies that were once believed to be the future. The late 1990s dot-com bubble provides the most vivid cautionary tale. It was an era defined by a collective obsession with what would change. The internet, it was correctly believed, would change everything. The mistake was in assuming that this seismic shift would automatically translate into durable, profitable businesses for every company with a .com at the end of its name. Investors stopped asking fundamental questions about profitability, competitive advantages, or even revenue. They were buying stories, not businesses. They were investing in the change itself. Take a company like Webvan. The idea was revolutionary. Order your groceries online and have them delivered to your door within a 30-minute window. This was the future of retail, everyone agreed. The company raised hundreds of millions of dollars and went public in 1999, its stock soaring on the first day of trading, reaching a market capitalization of over $1 billion. But investors, in their excitement about the changing how, online ordering, ignored the unchanging what, the brutal, low-margin reality of the grocery business. Webvan built massive, state-of-the-art warehouses and bought a fleet of expensive custom vans. Its costs were astronomical. The logistics were a nightmare. They were trying to perfect a high-cost delivery model for a low-margin product. Less than 2 years after its celebrated IPO, Webvan was bankrupt. All of that invested capital was gone. Or consider Pets.com. Its adorable sock puppet mascot was everywhere. The thesis was simple. The internet will change how people buy pet food. Again, investors poured money in, convinced by the narrative of change, but they failed to ask the invariant questions. What are the fundamentals of selling pet food? It's a heavy, low-margin product. Shipping a 40-pound bag of dog food across the country is incredibly expensive and wipes out any potential profit. Local pet stores and supermarkets already had efficient distribution networks. Pets.com was a company built on a Silicon Valley dream that crashed against the hard reality of physics and economics. It went from a Super Bowl ad to liquidation in less than a year. The dot-com bust was a multi-trillion-dollar lesson in the folly of chasing trends. Investors who focused only on the glittering promise of the new, without grounding their analysis in the boring, unchanging principles of business, were systematically wiped out. This is the path of the 99%, confusing a great narrative with a great business, and in doing so, paying the ultimate price for ignoring the simple wisdom of the oracle's inversion. This entire philosophy, this focus on the unchanging, is not just an abstract intellectual exercise. It has a profound and direct impact on the financial statements of a business and, consequently, on the returns you can expect as an investor. The direct financial connection is all about predictability. When a business is built on a durable, unchanging human need, its revenue streams become far more stable and predictable than those of a company riding a volatile technological wave. Consider the difference between a company like Johnson & Johnson and a speculative biotechnology firm. Johnson & Johnson sells products like Band-Aids, Tylenol, and baby shampoo. The demand for these products is remarkably stable. It does not meaningfully fluctuate with GDP, interest rates, or the latest tech trends. You can forecast Johnson & Johnson's revenue for next year with a very high degree of confidence. This predictability of revenue flows down the entire income statement. Margins are stable, earnings are stable, free cash flow is stable. Now consider the speculative biotech firm. Its entire future might hinge on the success of a single drug in a Phase 3 clinical trial. Its potential outcomes are binary. It could be a $10 billion blockbuster or a worthless failure. It is impossible to predict its future cash flows with any degree of certainty. In the language of finance, this uncertainty translates into a higher discount rate. When analysts try to determine the present value of a company, they project its future cash flows and then discount them back to today's dollars. The discount rate is essentially a measure of risk and uncertainty. The more uncertain the future cash flows, the higher the discount rate you must use. A higher discount rate results in a lower present value. This is why a company like Johnson & Johnson, with its boring predictability, can often command a higher valuation multiple on its current earnings than a more exciting but unpredictable company. The market pays a premium for certainty. By investing in businesses that serve invariant needs, you are essentially buying a less volatile, more predictable stream of future cash. This stability is the financial bedrock of a successful, long-term buy-and-hold strategy. It reduces the risk of permanent capital loss, it allows for more rational decision-making, and it provides the steady foundation upon which the magic of compounding can be built over decades, creating a path to portfolio growth that trend chasers can only dream of. Once you have made the mental shift to focus on the unchanging, the next logical step is to identify where these unchanging truths reside. The answer is simple and profound. They are embedded in our DNA, in the very fabric of human nature. The most powerful and durable businesses in the world are not built on clever algorithms or fleeting technologies. They are built on the bedrock of immutable human desires. This is the second great pillar of the Buffett philosophy, investing directly in the permanent psychological needs of mankind. The greatest case study for this principle, the Mona Lisa of Buffett's career, is his investment in the Coca-Cola Company. The story begins in the wake of the infamous Black Monday stock market crash of October 19, 1987. The market was consumed by panic and fear. Investors were dumping stocks indiscriminately, desperate to flee to the perceived safety of cash. It was in this climate of extreme pessimism that Buffett saw one of the greatest opportunities of his life. He wasn't looking at stock charts or listening to market pundits. He was thinking about a simple, brown, bubbly beverage. He had been drinking Coca-Cola for over 50 years. He saw it everywhere he went, in every country he visited. He observed its ubiquity, its cultural penetration. His analysis went far beyond the numbers. He asked himself, what is Coke? On the surface, it's just sugar water. Any competent chemist could replicate the formula. But the reality was that Coca-Cola wasn't selling a beverage. It was selling an idea. It was selling happiness, refreshment, nostalgia, a small, affordable moment of pleasure. It was woven into the fabric of social life around the globe. He reasoned that in the year 1988, approximately 300 billion 8-ounce servings of liquids were consumed every day by the world's population. Of that, Coca-Cola accounted for about 1%. The company was already a giant. But Buffett saw the other 99%. He saw a planet of thirsty people. He asked the invariant question, in 10, 20, 50 years, will people still be thirsty? Will they still seek simple, affordable pleasures? Will the psychological association between Coke and happy moments still exist? The answer was an unequivocal yes. The brand had created a permanent share of mind with billions of consumers. A competitor could create a better-tasting cola, they could price it lower, but they could never replicate the half-century of memories, the global advertising footprint, and the deep emotional connection that Coca-Cola had forged with humanity. Starting in 1988, Berkshire Hathaway began to buy and buy and buy. Over the next several months, he invested over $1 billion, acquiring a substantial stake in the company. It was a massive bet, made at a time of maximum fear, based on a simple insight into the permanence of a human desire. That investment has since paid Berkshire billions upon billions in dividends, and has appreciated in value to be worth many multiples of his original purchase price. A testament to the incredible financial power of investing in the bedrock of demand. The enduring success of companies like Coca-Cola isn't an accident of marketing. It is a masterclass in applied behavioral science. These businesses have learned to tap into the deepest, most primitive parts of our brains, creating a bond with customers that transcends rational calculation. One of the most powerful principles at play is the habit loop, a neurological pattern that governs much of our daily behavior. As described by author Charles Duhigg, this loop consists of three parts: a cue, a routine, and a reward. For a smoker, the cue might be finishing a meal. The routine is lighting a cigarette. The reward is the nicotine rush. Companies that build their business models around creating and reinforcing habit loops become incredibly resilient. Think of the 3 p.m. slump at work, the cue. The routine for millions is to walk to the vending machine and buy a Coke. The reward is the burst of sugar and caffeine, a small moment of pleasure that breaks the monotony. This loop, repeated day after day, becomes an ingrained, almost unconscious behavior. This is far more powerful than a simple customer preference. It's a neurological addiction, albeit a mild one. This is reinforced by other powerful cognitive biases. Social proof. The tendency to assume that the actions of others reflect correct behavior is a huge factor. When you see Coke everywhere, in movies, at sporting events, in the hands of your friends, it becomes the default, the normal choice. You don't even have to think about it. Then there's the liking bias, our tendency to agree with people we like, and by extension, to buy products from brands we have positive associations with. Decades of advertising have linked Coca-Cola with Christmas, with polar bears, with summer fun, with sharing and friendship. These positive emotions become subconsciously attached to the product itself. We aren't just buying a drink, we're buying a feeling. A company that can successfully entrench itself in our habits and associate itself with our deepest positive emotions, like happiness, comfort, and connection, has built a competitive advantage that is almost impossible for a competitor to assail. It operates on a psychological level that a spreadsheet analysis will never capture. This is the source of true, long-term, durable demand that fuels portfolio growth for decades. Translating this deep understanding of human psychology into an actionable investment strategy requires a specific mental model. We can call this framework the human desire map. It's a way to systematically identify businesses that are built on the most powerful and permanent aspects of our nature. Step 1 is to brainstorm a list of fundamental, unchanging human needs and desires. Don't think about products or companies yet. Think about the primal drivers of behavior. Your list might include security, status, connection, entertainment, convenience, pleasure, health, beauty, and the desire to care for our loved ones. These have been core to the human experience for millennia and will remain so. Step 2. For each of these core desires, begin to map out industries and specific companies that exist to serve them directly. For status, you might list luxury brands like Hermes, high-performance car manufacturers like Ferrari, or even social media platforms where people curate an idealized image of themselves. For convenience, you might list fast food chains, logistics companies like Amazon, or financial services that simplify payments. Step 3 is to evaluate the nature of the desire being served. Specifically, you want to analyze its intensity and its frequency. The desire for life-saving medicine, health, is incredibly intense, but for most people, infrequent. The desire for a daily cup of coffee, pleasure, habit, is lower in intensity, but occurs with relentless frequency. The most powerful businesses often sit at the intersection of high frequency and moderate to high intensity. A daily habit is a cash flow machine. Step 4 is to analyze how directly the company's primary product or service is linked to fulfilling that core desire. Is the product the solution to the desire, or is it merely a tool used in the process? For example, a pick-and-shovel company selling equipment to gold miners serves the desire for wealth indirectly. A company like Tiffany & Company, which sells the ultimate symbols of wealth and commitment, serves that desire directly. The more direct the link between the product and the fulfillment of a deep recurring human need, the more pricing power the company will have, and the more durable its business model will be. Using the human desire map allows you to look past the industry jargon and the quarterly earnings reports to see the real engine driving a business, its connection to the permanent wants of the human heart. The path of the 99% is paved with investments in companies that spectacularly misunderstood this principle. They made a fatal error. They confused a temporary method for a timeless need. They mistook the how for the what. A perfect, painful example is the story of GoPro. In the early 2010s, GoPro was a phenomenon. The company created a new category of small, durable cameras that allowed people to capture incredible video of their adventures. The stock market went wild for it. Here was a company that seemed to be tapping into a deep human desire, the desire to capture and share our most exciting experiences, a modern form of status and connection. The company went public in 2014, and its stock price more than tripled in a few short months, but there was a fundamental flaw in the analysis. The desire to capture and share experiences is permanent. The need for a dedicated, standalone, box-shaped camera to do so was not. The how was a piece of hardware, and hardware is always vulnerable to technological convergence. Within a few years, smartphone cameras became incredibly powerful. They became waterproof, they had image stabilization, they were also connected directly to the internet, making sharing effortless. The smartphone, which everyone already had in their pocket, could do 90% of what a GoPro could do for free. The need for the dedicated device plummeted. GoPro's stock collapsed, losing over 95% of its peak value. A more recent example is Peloton. During the unique circumstances of the global lockdowns, Peloton seemed like the future of fitness. It tapped into the permanent human desire for health and community, but it did so through a very specific how: a high-priced stationary bike connected to a subscription service. For a moment it seemed invincible, but as the world reopened, people's options expanded. They could go to the gym, run outside, or join a yoga class. The desire for fitness remained, but the intense demand for that specific, expensive solution waned. The company's valuation cratered. Both GoPro and Peloton are classic examples of businesses that offered a brilliant, temporary solution to a permanent problem. Investors who mistook the solution for the problem itself paid a heavy price. This is the crucial mistake to avoid. The winning strategy in long-term investing is not to bet on the next great gadget, but to bet on the unchanging human needs that those gadgets will, for a fleeting moment, be designed to serve. The financial power of aligning your investments with immutable human nature is staggering, and it manifests on the balance sheet in two critical metrics: customer lifetime value, or CLV, and customer acquisition cost, or CAC. A business built on a recurring, habit-forming desire has an astronomically high CLV. Think about a loyal Starbucks customer. They might spend $5 a day, 5 days a week, that's $25 a week, or $1,300 a year. Over a 20-year period, that single customer is worth $26,000 in revenue, and that's before any price increases. Because the purchase is driven by habit and a deep-seated need for a daily ritual, their loyalty is incredibly sticky. Now, compare that to a car dealership. They might make a larger profit on a single sale, but they have to reacquire that same customer a decade later. Their CLV for a given period is much lower. Simultaneously, these businesses have incredibly low or even negative customer acquisition costs. Coca-Cola does not have a team of salespeople cold calling you to try a Coke. Their brand is so powerful, their product so ubiquitous, that the acquisition is automatic. The brand itself does the work. When your brand is built on a fundamental human emotion, your customers become your sales force. They introduce their friends and family to the product, not as a sales pitch, but as a social ritual. This combination, an extremely high customer lifetime value and a very low customer acquisition cost, is the recipe for a profit-gushing machine. It leads directly to enormous, sustainable pricing power. Because the desire for the product is not based on a rational price comparison but on emotion and habit, the company can raise its prices by a small amount each and every year, far in excess of inflation, without losing its customer base. A 3% price increase on a can of Coke goes unnoticed by the consumer, but it drops almost entirely to the bottom line of the company. This ever-expanding river of high-margin free cash flow is the ultimate prize. It is this cash that can be used to pay dividends, buy back shares, and acquire other businesses, all of which directly contributes to the compounding of your initial investment and paves the way for a secure, prosperous financial future. So we have established the need to focus on the unchanging, and we have located the source of that durability in human nature. But serving a timeless human need is not enough. You must also ensure that the business serving that need can defend its profitability against the relentless onslaught of competition. This brings us to the third and perhaps most famous pillar of the Buffett philosophy, the absolute necessity of a durable competitive advantage, or as he so brilliantly metaphorized it, and quote, economic moat. An economic moat is a structural feature of a business that protects it from competitors, allowing it to earn high returns on capital for a very long period. The perfect story to illustrate the power of the moat is not one of triumph, but of near disaster: the American Express salad oil scandal of 1963. At the time, American Express was primarily known for its travelers' checks and charge cards, but it also had a lesser-known division involved in warehousing. This division issued receipts to companies for the inventory they stored in Amex's warehouses. Banks would then lend money to these companies, using the receipts as collateral. One of their biggest clients was the Allied Crude Vegetable Oil Company, run by a man named Tino DeAngelis. DeAngelis was a fraud. He had filled his massive storage tanks in New Jersey, mostly with seawater, with only a thin layer of salad oil on top. He used the fraudulent receipts from American Express to secure over $150 million in loans from dozens of banks. In November 1963, the fraud was exposed. Allied Crude went bankrupt, and the banks, holding worthless receipts, turned to American Express, demanding they make good on the losses. The market panicked. Wall Street assumed that the potential liabilities would bankrupt American Express. The stock price was cut in half in a matter of weeks. This is where a young Warren Buffett entered the picture. He saw the panic, but he decided to do his own research, what he called scuttlebutt. He didn't just analyze the balance sheet. He went out into the real world to see if the scandal had damaged the core business. He visited restaurants and hotels, talking to cashiers. He asked them if customers were still using their American Express cards and traveler's checks. They all said yes. He went to banks and asked if they were still selling Amex traveler's checks. They were. Buffett's key insight was that the warehousing division was an insignificant part of the real business. The real asset, the true value of American Express, was the powerful brand and the closed-loop payment network it had built in the minds of consumers and merchants. This was its moat. People trusted American Express. The scandal, while serious, was a temporary problem that hadn't breached the walls of that fortress of trust. He realized the market was confusing a temporary impairment in a minor division with a permanent impairment of the core franchise. Convinced of the moat's durability, Buffett invested 40% of his investment partnership's capital into American Express stock. As the company settled the claims for pennies on the dollar and the market realized the core business was unharmed, the stock roared back. Buffett made a massive profit. This experience cemented in his mind the idea that the single most important factor in evaluating a business is the strength and durability of its economic moat. The reason moats are so powerful is that they weaponize human psychology against competitors. One of the key principles at play is the commitment and consistency bias. Once we have committed to a choice, we experience internal pressure to behave consistently with that commitment. Moats often create high switching costs that lock customers in and trigger this bias. Think about your local bank. Moving your checking account, with all its automatic bill payments and direct deposits, is a massive hassle. The pain of switching is high, so you stay, even if another bank offers a slightly better interest rate. You are committed, and you remain consistent. The same is true for enterprise software companies. Once a corporation has trained thousands of employees on a specific software suite and integrated it into all of its internal processes, the cost and risk of switching to a competitor are astronomical. This creates a powerful moat that allows the software company to charge high prices and generate recurring revenue for years. Another psychological force that strengthens a moat is the brand halo effect. This is where our positive feelings about a single aspect of a brand extend to all of its products. The trust that people had in American Express travelers' checks created a halo of trust around their new charge card product, allowing it to gain market share rapidly. For a company like Apple, the positive experience a customer has with their iPhone creates a halo that makes them more likely to buy a Mac, an Apple Watch, and subscribe to Apple Music. This creates a self-reinforcing ecosystem, an incredibly wide moat that is as much psychological as it is technological. Competitors aren't just fighting against a product, they are fighting against years of positive customer experiences and a deeply ingrained sense of brand identity. When a company can build a moat based on these psychological principles, it moves beyond competing on price or features. It competes on trust, habit, and identity. battlegrounds where a new entrant has almost no chance of victory. To become a sophisticated investor capable of identifying these fortresses of profitability, you need a systematic framework. You can use what I call the 5 moats framework, which is a distillation of the primary sources of durable competitive advantage that Buffett and other great investors look for. The first step is to analyze for intangible assets. This is the most common type of moat and includes brands, patents, and regulatory licenses. A brand like Disney's is a powerful intangible asset. It allows them to charge a premium for theme park tickets, merchandise, and streaming services because of the deep emotional connection people have with their characters and stories. A pharmaceutical company's patent on a blockbuster drug is a government-granted monopoly, a powerful, albeit temporary, moat. The second moat is switching costs. As we discussed, these are the costs, in terms of time, money, or hassle, that a customer would incur to switch from one product to another. Your analysis here must be granular. Try to quantify it. How many hours would it take for a small business to switch its entire accounting system from QuickBooks to a competitor? That number represents the width of the moat. The third moat is the network effect. This is a powerful phenomenon, where a product or service becomes more valuable as more people use it. A telephone was not very valuable when only one person had one. It became exponentially more valuable as more people joined the network. The same is true for credit card companies like Visa and American Express, and social media platforms like Facebook. Every new user who joins makes the network more valuable for every other user, creating a virtuous cycle that is incredibly difficult for a new competitor to break into. The fourth moat is a cost advantage. This is the ability of a company to produce a product or service at a lower cost than its rivals, allowing it to either undercut them on price or earn higher margins. This can come from proprietary technology, but more often it comes from economies of scale. A company like Costco can demand lower prices from its suppliers because it buys in such massive quantities, an advantage a small corner store can never match. The fifth and final step is the moat durability assessment. Once you have identified a company's moat, you must ask the most important question: is this moat widening or is it narrowing? What are the biggest threats to this moat over the next 10 years? A company whose moat is actively getting stronger every year is the holy grail of long-term investing. This systematic analysis moves you from simply liking a company's product to deeply understanding its business structure and its ability to defend its profits over the long term. The antithesis to investing in moats is investing in industries where no moat can exist. For decades, Buffett used the airline industry as his prime example of a, quote, death trap for capitalists. The industry serves a fundamental human need, the desire to travel. It is a huge business. Yet, from the time of the Wright brothers until the late 20th century, the aggregate earnings of the entire U.S. airline industry were negative. Hundreds of airlines had gone bankrupt. Why? Because the industry has no sustainable moats. Competition is absolutely brutal and based almost entirely on one factor: price. If one airline lowers its fares on the New York to Los Angeles route, every other airline must immediately match it or lose all their customers. There are no switching costs for consumers. There are no network effects. Brand loyalty is minimal. Any competitive advantage, like a new fuel-saving jet, is immediately available to all competitors. The business is capital-intensive, requiring billions for new planes, and it is highly unionized, leading to high labor costs. It is a structurally terrible business. Investors who were attracted by the perceived growth in air travel consistently lost their shirts because they failed to see the absence of a moat. Now, contrast this with an industry Buffett later invested in heavily: railroads. On the surface, railroads seem like an old, boring, low-growth business. But Buffett saw an incredible moat. A company like BNSF, which Berkshire Hathaway now owns outright, has a network of tracks that is essentially impossible to replicate. Imagine trying to get the zoning permits and land rights to build a competing rail line from Chicago to Seattle. It would be a political and financial impossibility. This physical, irreplaceable network is a massive moat. It gives railroads pricing power, especially for heavy, bulk commodities where transport by truck is uneconomical. Unlike the airlines, where customers can switch carriers with a click of a mouse, if a coal mine in Wyoming wants to ship its product to a power plant in Texas, it often has only one railroad that can do the job. The lesson is profound. The attractiveness of an industry is not determined by its growth rate or how exciting its technology is. It is determined by its structure and the presence or absence of a durable economic moat. Pouring capital into a moatless industry is like pouring water into a leaky bucket. The financial manifestation of an economic moat is clear, quantifiable, and profound. It shows up most vividly in a metric called Return on Invested Capital, or ROIC. ROIC measures how efficiently a company is using its capital, both debt and equity, to generate profits. It is calculated by taking the company's net operating profit after taxes and dividing it by its total invested capital. A company with a strong and durable moat will consistently generate a high ROIC, often well above 15 or 20%. A company in a highly competitive, moatless industry will struggle to earn a return that is even equal to its cost of capital, which is typically around 8 to 10%. The difference is the engine of wealth creation. Let's imagine two companies, Company A, the Fortress, and Company B, the Arena. Both start with $100 million of invested capital. The Fortress has a strong moat and can consistently reinvest its earnings at a 20% ROIC. The Arena is in a brutal industry and can only earn an 8% ROIC. After the first year, the Fortress generates $20 million in profit, which it reinvests. Its capital base is now $120 million. The Arena generates $8 million, and its capital base is $108 million. The gap seems small. But this is where the magic of compounding takes over. After 20 years of reinvesting at these rates, the Fortress will have an invested capital base of over $3.8 billion. The Arena will have a base of only $466 million. The intrinsic value of the Fortress is now more than 8 times that of the Arena, all because of its ability to consistently deploy capital at high rates of return, an ability protected by its economic moat. This is how true generational wealth is built. It is not about timing the market or finding the next hot stock. It is about identifying these magnificent compounding machines, and then having the patience to let them work their magic over a lifetime. This is where immense capital gains are born, not from speculation, but from the predictable mathematics of a superior business. We have now established a clear philosophy: focus on the unchanging, tap into timeless human desires, and demand a durable economic moat. But there is a crucial fourth pillar, one that separates the professional from the amateur and protects investors from their own worst instincts. This pillar is the discipline of operating strictly within your circle of competence and the relentless insistence on a margin of safety. This principle is best illustrated not by a brilliant investment Buffett made, but by the thousands of brilliant investments he deliberately chose not to make. During the late 1990s, the world was in the grips of the dot-com mania. Technology stocks were soaring to unimaginable heights. Companies with no profits, and often no revenue, were achieving billion-dollar valuations based on nothing more than a promising idea and a fashionable domain name. Wall Street was euphoric. The media was celebrating a new paradigm where old rules of valuation no longer applied. And Warren Buffett, for the first time in a long time, looked like a relic. He was publicly criticized in major magazines for being a dinosaur, an old man who just didn't get it. His value investing strategy was declared dead. And what was Buffett doing during this frenzy? He was sitting in Omaha, Nebraska, reading annual reports of brick-and-mortar companies. He openly admitted that he did not understand the business models of these new technology companies. He could not, with any degree of certainty, project what their earnings and cash flows would look like in 5 or 10 years. He couldn't identify their moats or predict their durability. And because he couldn't understand them, he did nothing. He refused to play a game where he didn't know the rules. He was willing to endure the pain of underperforming the market and looking foolish in the short term, rather than risk his investors' capital on businesses he couldn't rationally analyze. He stuck to what he knew. Insurance companies like Geico, whose business model was based on predictable actuarial science, consumer staples like Coca-Cola and Gillette, whose products he understood intimately. Then, in the spring of 2000, the bubble burst. The Nasdaq Composite Index, a proxy for the tech sector, collapsed by nearly 80% over the next 2 years. Trillions of dollars of speculative wealth evaporated. The new paradigm was revealed to be the same old speculative mania, and Warren Buffett, the dinosaur, was vindicated in the most dramatic way possible. His decision to stay within his circle of competence, to avoid the siren song of easy riches in a field he didn't understand, was not an act of ignorance, but an act of profound intellectual discipline. It saved his shareholders from catastrophic losses and stands as one of the most important lessons in his entire career. Doing nothing is often the most profitable action an investor can take. The psychological demon that Buffett slayed with his circle of competence is one of the most pervasive and dangerous biases in all of human cognition, the Dunning-Kruger effect. This is the well-documented phenomenon where individuals with low expertise or knowledge in a particular area tend to dramatically overestimate their own competence. In investing, this manifests as the novice investor who, after a few lucky picks in a raging bull market, starts to believe they are a financial genius. They confuse luck with skill. They hear a compelling story about a revolutionary technology, they see the stock price going up, and they conclude that they understand the investment. In reality, they understand the narrative, but they have no deep understanding of the business model, the competitive landscape, or the true drivers of its long-term value. The circle of competence is the ultimate antidote to Dunning-Kruger. It is a conscious act of intellectual humility. It is drawing a line in the sand and saying, inside this circle are the things I know with deep, intimate, and expert-level knowledge. Outside this circle are the things I don't know, and I will not venture there no matter how tempting it seems. This is also connected to another powerful psychological principle, ambiguity aversion. Studies have shown that people prefer to take risks on outcomes with known probabilities, like a coin flip, rather than on outcomes with unknown probabilities, like pulling a colored marble from a jar with an unknown mix of colors. We hate ambiguity. We hate uncertainty. Most investors, paradoxically, do the opposite. They wade into highly ambiguous situations, like trying to predict the winner of a new technology race, while avoiding the more knowable, predictable world of established, simple businesses. Buffett's genius is in structuring his entire investment process to eliminate ambiguity. He only invests in businesses whose futures he believes are reasonably predictable. He turns the game of investing from a spin of the roulette wheel into a process of counting cards at the blackjack table. It's not about eliminating risk entirely, but about converting unknowable, ambiguous risks into quantifiable, manageable ones. This is only possible if you have the discipline to be brutally honest about the limits of your own knowledge. To apply this principle with the same rigor as Buffett, you can use a mental model called the napkin valuation test. It's a 4-step process designed to keep you within your circle and ensure you are always investing with a margin of safety. Step 1. Define your circle. This is the most important and most difficult step. Take out a piece of paper and write down the handful of industries that you understand better than the average intelligent investor, perhaps due to your profession, a lifelong hobby, or years of dedicated study. Be ruthlessly honest. If you cannot explain how a business in that industry makes money, who its customers are, and what its key risks are to a 10-year-old in less than 2 minutes, it is not in your circle. Your list might be very short. That is a good thing. A small, well-defined circle is a fortress. A large, ill-defined one is a trap. Step 2 is the predictability filter. Once you have identified a company that is squarely within your circle, you must ask the killer question: can I, with a high degree of confidence, estimate a reasonable range for this company's earnings per share 5 to 10 years from now? If the company is in a rapidly changing industry, if its success depends on a single patent, or if its profits are highly cyclical and tied to commodity prices, the honest answer is probably no. If the answer is no, you must discard the idea and move on, no exceptions. This filter alone will eliminate over 90% of all public companies as potential investments. Step 3 is the back-of-the-envelope discounted cash flow, or DCF. You don't need a complex 50-tab spreadsheet. On a single piece of paper or a napkin, take the company's current owner earnings. Free cash flow is a good proxy. Grow that number at a very conservative rate, a rate you are almost certain it can achieve for the next 10 years. Add a conservative terminal value. Then, discount that entire stream of future cash back to today's value using a reasonable discount rate. The result is your rough estimate of the company's intrinsic value. Step 4, the final and most crucial step, is to demand a margin of safety. This concept, first articulated by Buffett's mentor Benjamin Graham, is the cornerstone of value investing. It means you only buy a stock when its market price is significantly below your calculated intrinsic value. If you calculate a company is worth $100 per share, you don't buy it at 95, you wait until you can buy it at 60 or 70. This discount provides a cushion against errors in your judgment, unforeseen problems with the business, or general market downturns. The margin of safety is what separates investing from speculation. It is the built-in shock absorber that protects your portfolio and is the ultimate expression of a rational, disciplined approach to capital allocation. The path of the 99% provides a stark, modern counterpoint to the circle of competence. Look no further than the rise and fall of the ARK Innovation ETF, known by its ticker ARKK. This fund became a sensation by embodying the exact opposite of Buffett's philosophy. Its entire strategy was to invest in disruptive innovation, companies in fields like genomics, robotics, and artificial intelligence whose futures were, by definition, highly uncertain and unpredictable. The fund's charismatic leader presented compelling narratives about how these technologies would change the world. Investors, swept up in the stories and the fund's spectacular performance during a bull market, poured billions of dollars in. The valuations of the underlying companies were not based on current earnings or predictable cash flows, but on grand visions of their total addressable market, or TAM. It was a portfolio built not on certainty, but on hope. It was a deliberate strategy of operating far outside anyone's realistic circle of competence, because the future of these industries is genuinely unknowable. When the market sentiment shifted and investors began to demand profits instead of promises, the fund collapsed. The very same stocks that had soared on narrative and momentum crashed back to earth. Investors who had bought in near the top suffered devastating losses. The story of ARKK is the story of what happens when you abandon the principles of predictability and valuation. It is a cautionary tale about the allure of a good story. Buffett's approach is to invest in businesses that will be great, even if the story isn't that exciting. The antithetical approach is to invest in exciting stories, hoping the business eventually becomes great. One is a disciplined strategy for wealth preservation and growth. The other is a high-stakes gamble on predicting the distant future. The history of financial markets shows, with brutal clarity, which approach wins in the long run. The direct financial connection of this pillar, the circle of competence and margin of safety, is the active management of the most important variable in investing, risk. For most of Wall Street, risk is defined as beta, a measure of a stock's volatility relative to the market. This is an academic and, frankly, useless definition for the long-term investor. Volatility is not risk. A stock price can be volatile and still be a wonderful investment if you bought it at a low enough price. Buffett's definition of risk is far more practical. It is the risk of a permanent loss of capital. By operating only within your circle of competence, you are dramatically reducing the risk of making a major analytical error. You are less likely to misjudge the company's competitive position or its future earnings power. By insisting on a margin of safety, you are creating a buffer that protects you even if you are wrong. If you buy a stock you think is worth $100 for 60 and it turns out to be worth only 80, you still haven't lost money. This systematic reduction of the probability of permanent loss has a powerful effect on your portfolio's long-term compounding rate. One or two catastrophic losses can wipe out the gains from a dozen good investments. Avoiding those blow-ups is the single most important factor in achieving long-term financial freedom. This disciplined approach ensures your asset allocation is robust, that your capital is preserved, and that your path to beating the S&P 500 is paved not with brilliant flashes of insight, but with the steady, relentless avoidance of foolish mistakes. We have now assembled a powerful intellectual arsenal. We have inverted our focus to the unchanging, grounded our search in timeless human desires, demanded the protection of a durable economic moat, and confined our actions to a disciplined circle of competence. But all of this is for naught without the final, critical pillar. This is the element that transforms a sound philosophy into realized wealth. It is the active ingredient that ignites the exponential power of compounding. This pillar is the adoption of a long-term temperament, what we can call the 10th decade mindset. It is the triumph of patience. The quintessential story of this mindset is Buffett's investment in the Washington Post Company. In 1973, the stock market was in a deep funk. It was the era of the Nifty 50 collapse, a period where the darlings of the previous bull market came crashing down. The Washington Post Company, a fine business that owned the newspaper, Newsweek magazine, and several television stations, was caught in the downdraft. The market was valuing the entire company at about $80 million. Buffett did his analysis. He looked at the television stations alone and conservatively valued them at over $400 million. The market was offering him the chance to buy $1 for less than 20 cents. But his key insight was not just about the numbers, it was about the moat. In the 1970s, a dominant city newspaper was one of the greatest businesses imaginable. It had a monopoly on local news, classified advertising, and community information. This gave it immense pricing power. The Washington Post was the dominant paper in the nation's capital, an indestructible franchise. Convinced of the quality of the business and the absurdity of the price, Berkshire Hathaway invested nearly $11 million, acquiring a huge stake in the company. But the most important part of this story is not the purchase, it's what happened next. Nothing. For the next 30-plus years, Buffett simply held the stock. He held it through recessions and booms. He held it through political scandals and the Watergate triumph, which immeasurably enhanced the paper's brand. He held it through the birth of cable news and the dawn of the internet. He treated his stock certificate not as a flickering ticker symbol, but as a certificate of ownership in a superior business. That initial $11 million investment grew to be worth over $1.5 billion by the time Berkshire eventually sold its last shares decades later, a return of more than 100 to 1. This is the power of the 10th decade mindset. It is the understanding that the real money in investing is not made in the buying or the selling, but in the waiting. It is the patience to let a great business work its compounding magic over a human lifetime. This mindset is so rare because it requires a conscious and continuous battle against our own brain's flawed wiring. The primary psychological enemy is a powerful cognitive bias known as hyperbolic discounting. This is our brain's innate tendency to strongly prefer smaller, immediate rewards over larger, later rewards. Given the choice between $100 today or $110 in a week, most people will take the $100 today, even though the one-week return is an absurd 10%. Our brain is not wired for long-term, abstract rewards. It is wired for immediate gratification. This ancient reptilian part of our brain, the amygdala, screams for action now. It drives the day trader to chase a quick profit. It causes the panicked investor to sell at the bottom of a crash to stop the immediate emotional pain. It tempts the growth investor to sell a winner too early to lock in the feel-good sensation of a realized gain. The 10th decade mindset is the act of using our more evolved rational brain, the prefrontal cortex, to override these primitive impulses. It is the ability to mentally project yourself forward in time and appreciate the monumental difference between a small reward today and an enormous reward in 30 years. This requires training, it requires patience, it requires the emotional detachment to watch your portfolio fluctuate in value without feeling the need to react. Buffett has famously said that the ideal holding period for a stock is forever. This is not just a clever line, it is a deep psychological strategy. By setting forever as the default, he removes the constant nagging question of "should I sell?" from his daily decision-making process. The discipline of long-term holding is not a financial technique. It is a form of emotional regulation, a mastery over the self-destructive, short-term impulses that reside within all of us. To cultivate this essential patience in your own investing life, you can adopt a powerful mental model called the business owner simulation. This is a set of practices designed to shift your perspective from that of a stock renter to a business owner. Step 1. When you buy shares in a company, immediately reframe the action in your mind. You did not just buy a ticker symbol. You have just become a silent, fractional owner of the entire enterprise. You own a piece of every factory, every patent, every brand, and every employee's effort. This mental shift from playing the market to owning a business is the foundation of a long-term mindset. Step 2. Set a no-sell default. The burden of proof should never be on the act of holding. It should always be on the act of selling. Instead of waking up and asking, "Is there a good reason to hold this stock today?" you should ask, "Is there an overwhelmingly compelling reason to sell this business today?" The only valid reasons would be that the long-term fundamentals of the business have deteriorated, you have found a demonstrably superior investment opportunity, or you made a critical error in your initial analysis. Market volatility is never a valid reason. Step 3 is a powerful exercise called the 50-year letter. The day you buy a stock, write a one-page letter to your future self, to be opened in 50 years. In this letter, explain in simple terms exactly why you purchased this ownership stake. Focus only on the most durable long-term factors: the timeless human need it serves, the strength of its moat, the quality of its culture. Do not mention the current PE ratio or recent stock price performance. This exercise forces you to anchor your decision in the things that truly matter over the long run and serves as a powerful reminder during periods of market turmoil. Step 4 is the most practical. Automate and ignore. Set up an automatic investment plan to regularly purchase shares in your chosen companies or a low-cost index fund. Then, and this is crucial, delete the stock market app from your phone. Reduce the daily friction and temptation to tinker. By making your investment process automatic and removing the constant stream of short-term noise, you are engineering an environment where your long-term plan can succeed, protected from your own worst short-term instincts. This is the practical application of the buy-and-hold strategy that is essential for any retail investor seeking to build lasting wealth. The disastrous consequences of ignoring this final pillar are not theoretical, they are meticulously documented. Every year, a financial research firm named Dalbar publishes its quantitative analysis of investor behavior. Year after year, decade after decade, the results are the same, and they are shocking. The study consistently shows that the average investor in equity mutual funds earns a return that is dramatically lower than the return of the S&P 500 index itself. Over the last 30 years, this underperformance has often been several percentage points per year. How is this possible? Are the fund managers all incompetent? No. The reason for the gap is the self-destructive behavior of the investors themselves. They engage in the exact opposite of the 10th decade mindset. They buy high during periods of market euphoria when headlines are positive and their friends are bragging about their gains. They are driven by greed. Then, when the market inevitably corrects or crashes, and the headlines turn terrifying, they sell low, consumed by fear and a desire to to cut their losses. They constantly churn their portfolios, jumping from one hot fund to the next, racking up trading costs and taxes along the way. They are their own worst enemy. Imagine the emotional journey of a typical investor who ignores this principle. They see a tech stock soaring in 2020 and finally buy in near the peak, feeling smart. As the stock begins to fall in 2022, they hold on, hoping for a rebound. As the losses mount, hope turns to anxiety, then to outright panic. They finally sell near the bottom, crystallizing a massive loss, vowing never to invest in that stock again. Then, they watch from the sidelines as the stock eventually recovers and goes on to new highs, having experienced all of the pain and none of the gain. This is the path of the 99%. It is a cycle of emotional decision-making that guarantees underperformance. The 10th decade mindset is the only known cure for this disease. It is the simple, profound wisdom to understand that the stock market is a device for transferring money from the impatient to the patient. The direct financial connection of this patient, long-term mindset is the unrestrained magic of compound interest. Albert Einstein is apocryphally said to have called it the eighth wonder of the world, adding, "He who understands it, earns it. He who doesn't, pays it." Compounding only works its true wonders over very long periods of uninterrupted time. Let's look at the mathematics in a clear example. Consider two investors, patient Penelope and active Adam. Both start with $10,000. Penelope invests her money in a single, high-quality business with a durable moat that she understands. She plans to hold it for 40 years. The business generates a steady, predictable total return of 10% per year. She does nothing else. Adam, on the other hand, tries to time the market. He is clever, and in good years, he manages to earn a 15% return by jumping on trends. But every 4 years, he gets caught in a downturn and panics, selling and realizing a 20% loss before getting back in. After 40 years, Penelope's $10,000, left untouched to compound at 10% annually, will have grown to over $452,000. Now let's look at Adam. His roller coaster of returns seems higher on average, but the periodic losses and the interruption of the compounding process are devastating. After 40 years, his initial $10,000 will have grown to only about $148,000. Penelope, with her boring strategy and lower average returns, ends up with more than 3 times as much money. Her wealth was built by the unstoppable, exponential force of uninterrupted compounding. Adam's wealth was crippled by activity, by fear, and by the illusion of control. This is the ultimate financial argument for the entire Buffett philosophy. It is a system designed to identify superior businesses and then harness the most powerful force in the financial universe by simply getting out of the way. You have just invested a significant amount of your time and attention, and in doing so you have acquired a powerful piece of mental hardware. You have learned the oracle's inversion, the strategic framework that allows you to escape the chaotic, unpredictable casino of market trends, and instead focus on the bedrock certainties of business and human nature. This is not just a stock tip, it is a complete operating system for thinking about long-term value creation. You now possess the filter that can screen out the 99% of noise that derails most investors and identify the 1% of opportunities that can truly build generational wealth. But mastering this principle, as crucial as it is, represents only one part of a much larger, interconnected system of thought. Knowing how to identify a timeless, predictable business is like having the schematics for a powerful engine. It is essential, but it is not enough. An engine without a chassis, without a steering wheel, without a driver who knows precisely when to apply the gas and when to hit the brake, is just a piece of inert machinery. You have mastered the what kind of business to look for, but the other, equally critical half of the equation is the when. At what price does a great business become a great investment? This is the science of valuation, the art of understanding price versus value, and the discipline of acting with courage when others are fearful. The video that is now appearing on your screen is not just another piece of content, it is the missing link. It is the next piece of the map, the component that connects the engine of business analysis you have just built to the chassis of rational, real-world execution. It bridges the gap between identifying a wonderful company and buying it at a wonderful price. The journey to becoming a truly sophisticated investor, to achieving a state of unshakable financial freedom, is a process of assembling a complete mental arsenal. You have just forged the shield. The next step is to forge the sword. The choice of whether to continue that journey is yours. For those who are content with just a piece of the puzzle, the journey may end here. But for those who are committed to completing their ascent, to mastering the entire framework that has created more wealth than any other in history, the path forward is clear. Complete your arsenal. Click on the video on your screen now.